Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. Simon Brown from Consensys joins me as guest co-host this week, and he's a blockchain ecosystem advisor and researcher at Consensys, a leading blockchain and Web3 software company whose products like MetaMask and Infura are well known to the blockchain and crypto community. While overjoyed that Spot Bitcoin ETFs finally launched, I felt like something was not quite right about it, and I wanted to go deeper. There's an element of over-centralization of Bitcoin happening, and I wanted to get an expert opinion. Through the latest news on Spot Bitcoin ETFs, the Besu outage in the Ethereum ecosystem not reported by media outlets, the creation of the PBS or Proposer Builder Separation Foundation, and speculation on the next wave of Spot ETFs with ETH, Simon helps me to make sense of over-centralization of crypto and where we might go from here. All right here on Money Never Sleeps. Simon Brown, awesome to be talking to you today. Thanks so much for joining the show. It's really glad that I got that intro to you from Aaron Smith based upon what we've chatted about so far and what I know we're going to talk about today.
Great. Yeah. Thanks for having me. It's great to be on the show. Yeah. It's great that you got an intro from Aaron. He's a great guy. I haven't spoken to him in ages, but I worked with Aaron in Fidelity. He's a great guy.
Yeah, he is. He is. Irish guy living in London. I last chatted with him on Monday morning. So he connected us obviously. And it was him that I was chatting with one day and I'm like, oh dude, I really want to go down this certain path with a podcast discussion. And he's like, I know just the guy, Simon Brown. I'm like, perfect. Let's go ahead and do it. So before we dig into the stories that we're going to cover this week, Simon, why don't you just give our listeners a quick intro to you and your background and how you're looking at this space? Yeah?
Yeah, sure. So I got into the space around 2019. I discovered Ethereum in 2017. And when I discovered it, I became a little more than mildly obsessed. I was just really, really interested in Ethereum. It really captured my imagination how you can just build like a company with just a computer keyboard and an internet connection. And you can start accepting payments and build financial primitives, and just blew my mind. So at the time I was working in Fidelity Investments. I was actually like a developer, UI engineer. And I started like running these workshops that were open to anyone, trying to teach people how to build decentralized applications. And it was fun. But then in 2019, someone in Fidelity obviously had noticed that and said, hey, you're into this blockchain stuff. Do you want to do it full time? And I thought, yeah, I actually really do. So I joined their research and development wing called FCAT, the Fidelity Center for Applied Technology. That's where I met Aaron, where they do some really amazing and interesting work. And so I was there for 3 years building prototypes and development, but also kind of researching. And it was at that point I just got really interested in doing research. So after a few years, I wanted to move more into that field. So I joined Consensys about 2 years ago. So I'm an advisor for Consensys, doing research across emergent trends in the ecosystem and then advising both the CTO and CSO, but as well as the various product teams, some other bits and pieces as well. But mostly I just work for Consensys.
Okay. Very cool. Yeah. And with some of the materials you sent me in order to prep for today's chat, Simon, just seeing your name in a number of notable places was quite impressive. So I think Consensys are lucky to have you, and I'm sure Fidelity miss you. You're working on some pretty cool stuff. And in the last week, some pretty cool things happened in the crypto industry overall. And we touched on this, I did with our guest co-host last week, Alejandro Gutierrez, that we recorded our episode last week on the morning of the day that the Spot Bitcoin ETF was finally approved.
Wow,
so
exciting.
Yeah, I knew we were taking a risk, but I wasn't going to record later in the day. We weren't going to wait for the end of the market close in the US, which would have been 9:30 p.m. GMT, because I had something going on that night. And we just recorded that morning, and then I added in a snippet post-production just to acknowledge the fact that it happened. But it was quite the whirlwind of activity. We had the unauthorized multi-factor authentication, non-application control that happened, and where the SEC ended up having their account hacked. So
they say
the day before, but it's crazy everything that happened last week. It was a 10-year run We finally got there, and we saw 11 spot Bitcoin ETF products launched last Thursday and about $4.6 billion worth of volume. Now, Nick Carter from Castle Island Ventures pointed this out, which is we still can't figure out who's actually out front right now in terms of these 11 different sponsors or asset managers that launch products because of just the way TradFi works. But we had products from Fidelity, from BlackRock, Invesco Galaxy, Van Eck, Franklin, Wisdom Tree, Bitwise, Grayscale converted their trust into an ETF, and a handful of others. I personally see probably a 4 to 6 year time horizon for these products before they become the VCR, is what I'm thinking.
I agree. I think what's interesting about the Bitcoin ETF, well, all of the Bitcoin ETFs that have gone live, is viewing them against the backdrop of the SEC being openly hostile towards cryptocurrencies, including Bitcoin. And they're basically saying, we're not happy with this decision. And it really speaks to the inevitability of this technology. So with that in mind, I think you're absolutely right. Yeah, I think people will start to understand the principles of self-custody. And I think self-custody itself will become more user-friendly and easier and more secure and safer. And within 4 to 5 years, I think people will just be buying Bitcoin and ETH directly.
Absolutely. And I can't reveal the person who said this to me because they are actually one of the sponsors, and that a spot Bitcoin ETF is like recording a show on Netflix on your VCR so you can watch it later, right? And you can...
That's a pretty good analogy, yeah.
You can go in all different directions like that. And this individual said it to me about 3 or 4 years ago. What's really interesting is that all of those asset managers put in place processes here to buy Bitcoin direct in the market. Those investors that can't do that, the other institutional investors like pension funds, endowments, charities that are buying the ETF, that they would eventually just have their asset managers that run their mandates for them just buy direct. Okay. But as of right now, they can't have that reflected in their portfolios, buying direct Bitcoin. So BlackRock, Fidelity, Invesco, Van Eck, they all run portfolios for these big pension funds. So we're just going to see a shift from one container to the other. Because who are the pension funds going to pick to run the mandates for them when they can invest directly in Bitcoin? They're certainly not going to do it themselves because they don't invest directly themselves. Most of them don't. Some do, but most of them don't. It's going to be on the... So they'll just say, hey, BlackRock, listen, we're going to redeem out of the ETF, but that 500 million or whatever that we pull out, we're going to put that into a mandate where we want you to buy Bitcoin directly for us and trade that. That's all that's going to happen.
That's a good point. And I was thinking very much from the retail perspective. And I do think in retail, I think self-custody will see increased adoption. But from an institutional perspective, I think you're dead right. All of these big companies like BlackRock, Fidelity, they all have, well, I'm not sure if they all have, but certainly Fidelity has like custody operations.
Yep.
And it's quite big and it's very mature and it's very well established. So I think it's trivial to eventually move from buying through an ETF to actually just asking a custodian to buy Bitcoin directly or ETH. And I know Fidelity recently published their ETH investment thesis as well, which is quite interesting as well. I think the sense is that they're quite bullish on ETH as a long-term asset as well.
Yeah, definitely. The Masari crypto thesis for 2024 had some interesting views on ETH that as a long-term investment and being more analogous to a Visa or MasterCard than a Google or a Microsoft. And Alejandro and I dipped into that last week in the podcast. But there were a couple of points, just stories that came out this week on the Spot Bitcoin ETF. One on Friday that were just notable, I think, for the direction we're going with this, where it was the only sensible thing that Gary Gensler has said in a long time, which is that he sees the Bitcoin ETF irony in light of Satoshi's mission, says he respects Senator Warren and the law, which is fine. He needs to do that so that he can eventually get his appointment as the Secretary of Treasury. Did you hear about, there was this opinion piece a couple months ago that Gary Gensler just wants his signature at the bottom of the US dollar. And as Secretary of Treasury, that's what he gets. So if he is literally underwriting the US dollar. How could he underwrite Bitcoin? He can't. He can't approve it. He did approve it, but in his statement of approval, he said, listen, it's illicit activity. That's what it's primarily used for. He doesn't condone it, blah, 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 blah. Right? Where we know the biggest source of illicit activity in the world, the biggest means of funding illicit activity is the currency that he would like to sign, which is the US dollar. So.
Yeah, of course. Yeah, and he said, like, famously, he talked about stable coins, and he's like, we don't need stable coins. We've got a digital dollar. We've got Visa, we've got MasterCard, and we've got Google and Apple Pay. That's all we need. So, yeah, I think Gensler has been very open about being a critic of cryptocurrencies in general and a skeptic. But again, as I said, that's kind of like, with that in mind, it's interesting that the Bitcoin ETFs went ahead anyway. So it does speak to the inevitability of the whole thing. So,
yeah.
But yeah, I did hear Gensler say one thing that kind of resonated with me. He did talk about how the Bitcoin ETFs run counter to Satoshi's original vision because they introduced centralization, which is, on the face of it, it's just like, oh, it's just Gary's going off again and he's going to say anything that's against Bitcoin. But if you think about it, he kind of has a point as well. And it's an area that I've been always interested in terms of this kind of like the tension between centralization, forces of centralization, and the aspiration to be decentralized. Because the forces of centralization come from everywhere, and coming from large amounts of institutional capital flowing into the space is another way that it's something that we need to be maybe somewhat vigilant against in terms of like the influence it can have on the ecosystem.
Definitely. And you're in with the ETFs, and he's right. And like I said, it's the only sensible thing he said in a while, is that we are over-centralizing this by putting them into these containers of ETFs. For example, BlackRock held 11,500 Bitcoin as of Friday, 12th January, or about $500 million, which is ahead of Tesla and behind MicroStrategy, which is a software developer in the US, Michael Saylor, who is a big believer in using Bitcoin to finance his balance sheet. So the amount is significant. There was a reporter in Crypto Slate said that only 900 BTC are issued daily. If this trend continues, the Bitcoin market could face a severe supply crunch. And of course, folks love to hear that, because with a supply crunch, you get prices go up, more or less. So, but again, stepping back and looking at this from a long-term perspective, totally agree. We are over-centralizing this. I think in the grand scheme of things in the long term, I'm hoping that it will be a short-term blip in over-centralization as this asset class grows and more wealth around it is spread out around the world. And that even sometimes me just saying that, the wealth around this asset class obviously is inconsistent with Satoshi's vision, right? That this is a peer-to-peer electronic currency. But that was 15 years ago, and the world has changed. I think we're on a unique path here. This is an asset that has some economic qualities, referred to as, people say it time and time again, as digital gold. But again, long-term view here, people always tend to overestimate the impact of technology in the short run and underestimate its impact in the long run. Roy Amara said in the 1960s, right?
I think like there is some nuance there, especially in terms of like Bitcoin. And I suppose it's different from the retail versus the institutional perspective. Okay, well, let's look at it from the retail perspective in terms of like people holding Bitcoin. If they hold Bitcoin through Grayscale or like even on an exchange like Coinbase, Binance, take your pick, it's not self-custody, and they're leaving themselves open to having their assets seized by some regulatory authority at some point in the future. Now, administrations could change in the US or elsewhere. They could change 2 or 3 times over the next 15 years. And we can't really see into the future. But we have seen precedents in North America. Say, for example, in Canada, where protesters had their financial assets and bank accounts frozen, right? That's a very recent precedent that happened, where the government enacted regulatory overreach to seize people's assets. Okay, so if you're not holding Bitcoin directly, then there is that risk. Okay, now maybe we're over-indexing. It might never happen, but I'm just saying it has happened to a small degree. There's a non-negligible risk it could happen if you're not holding the Bitcoin yourself. So from a retail perspective, the less self-custody and the more Bitcoin is held by like these large exchange traded funds, the more of the risk there is. From an institutional perspective, it's slightly different because I think you can't just go in and seize people's retirements. Well, I suppose you can and you can't. If you look back at what happened to Greece in 2008, there is precedent for that as well. But like there is that social pressure on these large institutions, and that I suppose creates some nuance. But it's still not in line with Satoshi's vision of like everyone participating in the network themselves. But I think in Bitcoin, it's like maybe not as much of a risk as you have in Ethereum, which is a much more complex ecosystem, and other things like other networks like Ethereum, where you've got proof of stake, which is a lot more complex. There's a lot more vectors for centralization, and probably it's maybe more of a concern there.
Yeah, and I think the way I'm looking at this is that, okay, Bitcoin in market cap is approaching 1 trillion, or it will get there.
Mm.
And imagine that at 10 trillion. And what is the makeup of that in terms of the holders of that? Is there a lot of institutions in there? Is it a lot of retail? What is the mix there, and how is it being used? I think that story is largely unwritten, and that things are just changing so fast. I just don't know how it's going to happen. So will Satoshi's vision come to light on a grand global scale with Bitcoin? I don't know. But it's, to me, a very unique asset class with incredibly unique properties. But we'll see.
What fascinates me about this whole space is that, and I think what large institutions are slowly becoming more comfortable with is that it's not actually a technology. It's a socio-technology. That's like very different. And like if you think about when the cloud computing revolution, like 15 years ago, and a lot of like companies that had previously run their own data centers at great expense started slowly placing their trust in the public cloud, right? And started moving all of their data and all of their programs over to like Amazon, AWS, Microsoft Azure. And like it didn't happen overnight. It was a slow kind of relinquishing of control over to these public clouds. But at the end of the day, they could sign a contract. They could have their solicitors look at it. They could sign a service level agreement to say, we want 99.99% uptime. And that allowed them a certain amount of confidence. You can't sign an SLA with Bitcoin or Ethereum.
Yeah.
Right. So you're slowly relinquishing control and trust into this thing, but it's not a company. You're not dealing with a company. You can't sue them. Right. And that's really, really interesting because it's not just a technology. You don't achieve decentralization by writing really, really clever consensus algorithms. And then once they're written, you deploy them and that's it. You achieve decentralization through social consensus, right? And that's what underpins the entire thing. And so when you put those kind of those axioms together, what you realize, the insight you get is that these large institutions are putting a lot of money and capital and trust in essentially a social construct, which I think maybe I'm getting a little bit philosophical, but like when you think about that's quite a big paradigm shift. And that's what fascinates me.
It is. And to position that against fiat currency, there's a lot of social trust in fiat currency. I didn't look this up until a couple of years ago. What does fiat actually mean? And for those out there, I get asked when I talk to people who are not involved in crypto, what's fiat? I'm like, it's traditional currency. And fiat means something has value because someone else says it does.
Right.
And when they removed the gold standard from currencies in the 1970s, when US dollar started, that it's only worth something because somebody says it is. And they say, well, there's a full backing of the US government. I'm like, well, what can you actually get for it? Can you get another currency? Could you get a lump of gold? No, you can't. So if that currency inflates beyond belief, there's nothing left. And it only has value because somebody says it does. In crypto, it's, well, what is someone else willing to pay for it? So what is the price? The price is what someone else is willing to pay.
Yeah.
So again, philosophical, but I think we could keep going down this Bitcoin rabbit hole for a while with everything around this, but thinking about the other side of the pond with this, with Ethereum. I know that is your favorite pond to swim in, perhaps not a pond, but a big lake, perhaps a massive ocean, perhaps one on another planet. But for us Earthlings here, right? I know that a lot of the work that you do is around looking at the Ethereum ecosystem overall and saying, all right, what is the health of that ecosystem? And that there were some things that happened in the last couple of months or so. One that was an unfortunate development, but luckily minimized in terms of its impact and extent across the ecosystem. But one probably as well as more positive in terms of the long-term outlook and where things should go. But do you want to give us some insight into the first one around the Besu outage?
So it was very much a non-event, but that's a good thing. It was basically a bug that affected one of the clients, one of the execution clients on Ethereum. And it was patched really quickly and that was fine. So as you know, or may not know, there's a whole bunch of different client software that you can run on Ethereum. Like similar to Bitcoin. I think in Bitcoin, though, the vast majority of clients, nearly all of them, they just run Bitcoin Core, this one piece of software. In Ethereum, Ethereum is like basically two networks like merged together, and each network has roughly 6 main clients that you can choose and you can put them together. On the execution side, where you actually build and verify transactions and build blocks, one of these clients is called Besu. It was developed by Consensys, and it has a reasonably small network share. I think about 5% of the network run Besu as an execution client. And for a few hours, there was a bug that affected not all of them, but maybe like 75% of them, of the nodes running Besu, and they stopped producing blocks. And it was a very, very interesting case because I looked into it and I was like, what's going on here? So there was this known issue, and they had been testing it on the test networks to try and figure out like when is it going to happen? What triggers it? Somebody deployed a really weird, peculiar smart contract to the mainnet. Ostensibly, that has no purpose. And they funded it with some ETH, and then they destroyed it a little bit later. That smart contract seemed like it was specifically designed to trigger this error. And so someone knew that they could do something. It looked like maybe they were experimenting, but we don't really know. It was just a very peculiar smart contract. No real motivation or rationale. But what it did actually trigger this state storage error. 75% of this 5% cohort of the network stopped producing blocks. The team are a really solid team of engineers, and they were instrumental in actually helping the merge and designing and architecting and implementing it. But they looked at it, they fixed it, that was fine. Well, I looked at it and I thought, wow, so this happened to Besu, right? A really, really solid piece of software with an incredible engineering team. What if this had happened to Geth? When you look at Geth's market share, which is another big execution client, that has 84% of the market share. So if they had some sort of bug that some smart contract deployment triggered, 84% of the nodes on the network essentially would stop producing blocks. And that would have a huge impact. You're getting very close to having the chain halting at that stage, right? But essentially, it's not going to halt, but you're just going to get probably like empty blocks, missed slots, no transactions being processed. And it would probably be resolved pretty quickly, probably in a matter of hours, or at the very worst, 24 hours. But again, if you're thinking like $10 trillion market cap in like 5 to 10 years, that sort of outage is catastrophic. Yeah, so I think there was this tiny little blip that no one noticed, but it became so close that I think it needs people like me to kind of like shout about it a little bit more and say, hey, I think we need a little bit more client diversity. I think that's really important.
Oh, definitely. Yeah, it was really eye-opening for me because like you said, okay, there's a number, you said 6 different execution clients that are used in the Ethereum network.
Yeah.
And yes, Besu being only 5%, but Geth, GETH being 84%.
Right.
That is huge. And I think you also shared with me a post from Hani Abu. And I knew a Hani Abu back in the days, but it was a different one.
Oh, really?
His brother was my roommate back when I lived in Bermuda. But Hani Abu owned a few different retail franchises in Canada. And we'll leave it at that. He wasn't involved in Ethereum. So, but I saw his scenario out, or him playing out the scenarios on Twitter, on X, and said that If this had happened to Geth and had this kind of outage, the financial loss would range from 3.8 billion up to 49 billion, depending upon the scenario, which was pretty eye-opening, which says, listen, this is a massive global network of value and value transfer. And if, and to the average person out there in the world that may have heard of Ethereum, may not have heard of Ethereum, that it is just far beyond their ability to really comprehend that you get this one bug or this one smart contract, this one peculiar smart contract, like you said, that gets deployed into the ecosystem, it can cause havoc. And the 3.8 billion to 49 billion estimate, is that when you saw that, did you think, oh yeah, that could happen?
Under the right circumstances, sure. The reason we have client diversity, the reason there's like 6 different kind of execution clients, and the reason there's 6 different consensus clients, and that took a phenomenal amount of effort from all of these different teams to build something that doesn't really generate any revenue for them. So it was a huge cost sink for all of the teams that built those different clients. The reason they did it is because of this very issue, and they realized that client diversity is important. But that's the whole point about decentralization. You don't just like arrive at decentralization and then job done. It's like a perennial problem that we're all stewards of. And so it's based on social consensus and people shouting out about it and making noise. And so that's why I wanted to highlight this. I guess if people are listening and they work for a company that's running nodes that has validators attached to them, it might be worth like turning around to the engineer at the next desk and going, hey, how many gas nodes are we running? Maybe we should swap some of them for Aragon or Besu or some of the other execution clients. And that's how it works. I think we will get back to client diversity, and the way we'll get back, like we'll get that majority share of Geth down again and protect the network. And how we'll do that is just through people making noise and giving out like I'm doing.
Okay, that's it. That's what I was going to ask you, because you shared with me as well that clientdiversity.org, and I'll put this in the show notes, on showing the client distribution on the consensus clients versus execution clients. On the consensus clients, it looks relatively healthy, right? Where we got one at Prism at about 40%, and then 5 or 6 others with less than that, but it looks like a good spread. And that execution clients, a big red bar that says Geth at 84%, Nethermind at 8%, and then Besu down to 5%. And then, we need to do something there. So you're saying no new major development of another execution client is necessary. It's just that the engineers need to spread the load out across these different types of execution clients. Yeah.
Yeah, exactly. That's exactly it. And I don't think on the execution side, I don't think it's always been this bad, but I think maybe people get complacent and then it's easier to spin up new nodes. I don't know why Geth particularly. I know it was like the original clients, so maybe it's easier to work with. The level of decentralization waxes and wanes, but I think with enough social pressure that people will go back to like distributing it more evenly, and like at that point, then we can take the hit of a bug in any one of the clients, and I think now is the point where we're in the danger zone, because this is like we just had a hard fork last night, and ostensibly it went seamlessly and everything's fine. But it's not the last hard fork. So all of these hard forks are an opportunity for a bug in any one of these clients. So yeah, it's important, but hopefully we'll restore an equilibrium.
Yeah. And there's another dashboard that you shared as well, again, that I'll put into the show notes that I'll come back to later, called Project Sunshine, because a couple of things stood out to me on that in terms of staking. The other point that you shared was the creation of the PBS Foundation. And like you said to me, this is not the public broadcasting service, thank you, Sesame Street, that is behind the creation of this foundation. It is something else entirely, and the Proposer Builder Separation Foundation. Can you tell us about what's going on here? I know you recently joined the newly formed PBS Foundation as a member.
Yeah, so I'd love to take the opportunity to talk about that. This was an idea that first came from Tina at Flashbots. And Tina she's an incredible steward of the ecosystem and always very interested in trying to push the interests of the ecosystem forward. So she came up with this idea and put it out there, and then it snowballed. And it resulted in setting up this, what was originally called the PBS Guild. I don't know why we changed it to BPS Foundation, because people just think
Okay.
of Sesame Street. But essentially what it is like a vehicle for funding grants into research and into neutral infrastructure in the ecosystem. So right now we are at a stage where Ethereum is a pretty complicated ecosystem with a multitude of different independent actors working together in different roles. But it's not quite as decentralized as we aspire to. And in particular, I think with proposer-builder separation, we've got a lot of centralization around builders. So I don't know how familiar people are with Ethereum and how it works, but currently how it works is that you've got this fast validator network. We've got over 1 million validators. Those validators are, each one of them has staked 32 ETH, and they come from random people who have staked their ETH, right? They're attached to nodes. There's currently about 15,000 nodes on the network. We think about 5,000 to 6,000 have these validators attached to them, right? So you've got 1 million validators attached to about 5,000 or 6,000 nodes. None of those, well, only about 10% of them actually produce blocks. Mostly their job is just to validate blocks that are produced by specialist entities called block builders. So the block builders produce blocks. They can't really do anything else. They can't produce like a bad block or just insert their own transaction or make money, because the validators will just kick their block out. But they do have a certain amount of power. They can just leave transactions out of a block. They can decide to just put an empty block with one transaction in it. They can mess around, okay, to a degree that is concerning. And why this is an issue is because if you look at the block builders who produce these blocks, there's basically like 3 of them that produce 75% of the blocks on the network. And an interesting bit of trivia is all 3 of them are based in London, and it's not unusual for them to be in the same room having coffee. So,
wow.
It's not. Now, I will say that they are highly constrained. So there's not a lot of damage they can do, but there is more damage that's potential that they could do, that's like through regulatory coercion from one jurisdiction or another. And so it's something that we'd like to improve on. How we improve on it is a difficult problem. And so it's going to require a lot of research. This far, a lot of research has come from economists and people working in the Ethereum Foundation and various other people around the ecosystem. So the PPS Foundation is really trying to coordinate. So it's trying to coordinate efforts so that people aren't duplicating work. So people are learning from each other's work. So for people who have an idea but don't necessarily have the funding to pursue the research idea, we can actually fund them. So the PPS Foundation is open for applications, and we've seen a number of applications come in that range from small educational initiatives for that maybe take 2 or 3 weeks to like larger research pieces that we fund for up to 6 months. We're currently reviewing applications. It looks like we're going to fund the first few relatively soon. And this is a big deal, right? Because this is how we move forward. It's like how we actually get research that people can agree on that finally becomes implemented, that can increase the properties of like censorship resistance and credible neutrality in the system. So it's a very exciting initiative to be a part of, but one that I definitely want to increase more awareness of.
Yeah, very high profile as well. And I saw support from Coinbase, Consensys, obviously, with you there, Fenbushi Capital, and I know a couple of the guys there, Flashbots, as you mentioned, Paradigm, Uniswap Foundation, and Vitalik Buterin himself. So to the average person on the street that looks at crypto a certain way and not as the future financial rails for the world, one of the things Alejandro and I talked about last week was this analogy that Ryan Selkis from Masari made to MasterCard and Visa, and saying that he sees Ethereum more in that light than a Microsoft or Google. And Visa and MasterCard, and he was talking about their networks, not necessarily them as companies. And my comment was, well, it's kind of a quantum leap beyond Visa and MasterCard. And that in terms of things such as a guy called Matthew Lamerrill said a couple of weeks ago in another podcast that in the 90s and 2000s with the internet, that we were digitalizing content and communications. And now we are digitalizing commerce and finance. It's that the internet that we originally built isn't fit for purpose, and we need a better internet. And that's where the term Web3 came from, and that the next version of the internet that we're working on now. And to the average person on the street, where they don't see this going on. They don't know about it. Folks like you that are working on this every single day are seeing where it needs to go. And it's that trying to just get some public attention on this and to promote things like the grants from the PBS Foundation and make people aware of that. Those are all good things that we need to do. And people may look at me and think I'm crazy saying that, well, these are the future financial rails of the world. So I truly believe that. And that future is already here. It's just unevenly distributed, which is Gibson's law, right?
Yeah, I think like if we do our job well, people never need to know that we've ever transitioned over to using Ethereum instead of Visa and MasterCard, or that Visa and MasterCard use Ethereum instead of their clunky merchant network. It's analogous to HTTPS, right? Years and years and years ago, because you could download apps and you could log on the network. You could sniff the network traffic and you could just look at the images that people were sending, right?
Wow.
Yeah, you could do that. Well, you can't do it anymore. I think that's the point because of HTTPS, because everything's encrypted. But I remember when HTTPS there was a huge social drive to encrypt everything. A lot of that came from the Electronic Frontiers Foundation, EFF, who famously created Let's Encrypt with Mozilla Foundation that made it so insanely easy to generate a HTTPS cert. And then Mozilla started saying, we're going to start warning people when they go to a website that is not HTTPS, and we're going to tell them not to go. And then all of the other browsers followed. And now HTTPS is boring and no one ever thinks about it.
Yeah, I know. When people are like, well, Pete, you got these coins in your digital wallet. How do you know how they work? I'm like, when you get an email, do you care about how that protocol behind it worked?
Right.
No.
But someone did have to figure it out. And people in the EFF had to care and had to create that drive. And I think there's a strong analogy to what we're doing in the PBS Foundation, which is seeking and trying to support researchers to do something similar, is to figure out the hard problems so that we can forget about it and move on. I think that's.
I know, and it's crazy, and I could just see this where there's 15 million daily active users at best of something like a MetaMask right now, right? And even though we have over 350, 400 million crypto addresses around the world, maybe more than that at this stage, that it's still back to less than 15 million people. So it's a very small microcosm of society that are working on this.
Yeah.
And for folks like you and me, this is the biggest part of your day, okay, other than family. And so it's really interesting to envisage the future where all of this is just commonplace and people don't think about it anymore or talk about it. It's no longer Web 3, it's just the web. Perhaps there's a Web 4 or Web 5 that people are talking about. It's no longer crypto assets, they're just assets. And that's just how the world operates.
It's going to become more ubiquitous, I think, because like part of it is other external focuses outside of Web3 that are inadvertently going to push forward Web3 as well. And I'm thinking in terms of identity and reputation as well, which is an entirely different topic. But I know that the IDAS framework in the EU is going to start pushing out verifiable credentials to people. If that's successful, that's a market of like 450 million people who all need some form of wallet. That will kind of like be a huge boon to the idea of having digital assets, whether it's like your identity credentials or some sort of token, like in a wallet. And as the mimetic quality of that kind of becomes more ubiquitous, people will start thinking MetaMask maybe isn't that strange a concept. And it's going to become more familiar.
Can I ask you this, though? And this is something that for the longest time in crypto, we strongly preferred the prioritization of security over usability. And that so we end up with a ecosystem where you may need to flip between different wallets for different chains. And obviously that's progressing. We may need to toggle between those different chains from within a single wallet. And that the analogy to, well, the first time that you logged on to a fintech banking app, you probably had to jump through a lot of hoops to do that. So now it is more commonplace, but I think we will go a step further with the further simplification of digital wallets, with hopefully new capital being driven into this industry with some uplift that's expected in 24, 25. Do you see an uplift of UX, given your background in UX, happening over the next few years?
Oh, it's happening now. And even in the past 12 months, there's been incredible innovations, especially in the space around account abstraction. But again, it's one of those things that, like, the more progress you make, the more progress that you realize you need to make. But already, I think in the past 12 months, we've seen the whole idea around the notion of progressive self-custody, whereby you might start with embedded wallets where you don't need to install MetaMask or Rabi or Tally or any wallet. It's embedded into the application you're using. And that could be on anything from like Shopify, I don't know, TripAdvisor or whatever big platform people use.
Yeah, or a government app that you use perhaps for your tax reporting and things like that, that now has an embedded wallet for your digital ID that your government issues to you.
Exactly. But they're not secure, right? They are secure, but they're not really secure. But that's okay, because for like a small transaction or a small value transaction, they're more than sufficient. And you can just have immediate access and there's no friction. As your assets become more valuable, then the UX can start to slowly prompt you to build in more self-custody in the same way that applications want you to log on and go straight away, like single sign on Google, and then you're in. But then slowly they might start to prompt you to go, hey, maybe you should think about two-factor authentication. And have you got a backup email address, and so on and so forth. And I think that's the route that UX is going, very accessible wallets, and then progressing up to like more robust wallets, such as the way MetaMask is today.
Definitely.
Yeah.
And the last point I wanted to touch on with you today, Simon, was, and again, on the trend of over-centralization, and that with the Spot Bitcoin ETF behind us now, that the next big thing that people are looking at is the Spot ETH ETF or Spot Ethereum ETF. And BlackRock and others are talking about this as well. And just considering what's happened now, as of recording time, right now on CoinMarketCap, Bitcoin's at about 838 billion in market cap. Ethereum's at about 306 billion. The projection for this year, Standard Chartered, was pushing Bitcoin ETF inflows, expecting 100 billion that would come in. And so we'll see what happens with the Bitcoin price this year, but as of it, with a conservative view, that will end up being at least 10% of the market.
Yeah.
With Ethereum being, and people are waiting for the flipping eventually to happen, which is Ethereum to flip Bitcoin in terms of market value. I think it will in the long term. That imagine, say, even 30 billion coming into a Spot Bitcoin ETF over the course of maybe not a year, but maybe 2 years. And that could be, again, we're expecting to see an uplift in ETH over the next 12 to 18 months. And that could be, say, a conservative estimate, 5% of the market would be perhaps in ETFs. And one of the big differences between Bitcoin and Ethereum is, like you said, staking. And the fact that staking rewards can be paid to validators, and that those are then passed down to those that are holding Ethereum and staking it themselves. As this market develops with perhaps this even greater compelling value proposition of Ethereum compared to Bitcoin as an investment asset with staking rewards, and where right now the ETH that I stake is something like 3% on an annualized basis that I receive as a reward for staking my Ethereum. And I will, beyond that, when we're thinking about, say, someone like a BlackRock coming in and buying just as much ETH as they bought Bitcoin, or perhaps even half of that, and the impact that will have on the staking ecosystem and those that are providing the infrastructure for nodes and for validators. Do you see perhaps a bottleneck risk there that might unfold with a Spot Ethereum ETF?
That's I have absolutely no idea, but I'm very much looking forward to seeing how it unfolds. It's going to be interesting. Yeah, what providers do, like one scenario is that it actually evens the playing field. If like large institutions
Yeah.
like BlackRock, Fidelity, whoever, actually start running their own staking operations, maybe we won't see the dominance of like large staking pools like Lido, which have a very maybe a very dangerous level of stake already. But what does that mean? Is that good? Is it bad? It's good because maybe it levels out the market share, and maybe Lido don't have 30%, they only have 20%, and these large institutions take that other 10%. So that's good. It's also bad because Lido is a decentralized, is a DAO at the end of the day, and they set very strict policies about like how geographically distributed their node operators should be. They have very strict policies around client diversity, and that's probably one of the reasons why we have such good client diversity on the Consensys client side. But will institutions have the same sort of ethos? Will they go to the same degrees? Will they have the same sort of transparency as Lido? So it's pretty nuanced. I don't know. Certainly, these ETFs aren't just going to hold ETH. They're going to stake it. Yep. Will they restake it? And if they're going to restake it, how are they going to manage that? There's going to be 1,000 different AVSs that they could earn yield from with different risk-reward profiles. So how will they manage that? And how transparent will they be to their customers? And what does that mean for the network? So yeah, if you can figure it out, let me know. It's going to be pretty interesting.
No, and it's one to watch. And that dashboard you shared with me, the Project Sunshine one, and again, I'll put that in the show notes, shows it pretty clearly where we are right now. Staking pool diversity is red, right? As we are right now.
Yeah.
Okay. Sure. So I think that will expectedly go a bit more red. And that, like you're saying, with making people aware of the Besu outage, making people aware of the PBS Foundation and all the good work that's going on there, will perhaps get some more attention in the ecosystem, saying, hey, we've got to make this whole ecosystem a lot more diverse. In my opinion, not just in terms of technological diversity, but also in terms of gender diversity. So we got a ways to go there as well, right?
Yeah, I agree. Yeah,
absolutely. Well, listen, Simon, this has been an excellent conversation. I really appreciate you coming on to hash through these things with me, no pun intended. And I look forward to our next chat on this. So thank you.
Absolutely my pleasure. Thanks for having me on.
That does it for this week, folks. And you can learn more about what we just covered in the show notes on our website, moneyneversleeps.ie. Thanks to Simon Brown for all the insights he shared in co-hosting this episode with me. If you like what you heard, please leave us a rating and a review on Apple Podcasts or Spotify, as it helps others to find the show. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm an early-stage startup investor focused on where fintech meets crypto and crypto meets Web3, and I lead the Techstars Web3 Accelerator. There are plenty of links in the show notes on moneyneversleeps.ie on how to get in touch, so don't hesitate to reach out. Finally, till next time, thanks for listening. See ya!
Money never sleeps, pal.